Welcome back to Global TA. Today we're going to be discussing the second part in an 8-part series of this trading course called Global Technical Analysis, or Global TA for short. And really what we're going to focus on today is the fundamentals. Just like Michael Jordan, every single day of practice would practice the basics. He would practice bounce passes. He wouldn't go out and practice, doing 360s, doing dunks, all these crazy things that you see people in the NBA doing now that aren't the best. The best people in any industry focus on fundamentals. And that's why today we're going to start with the fundamentals. And basically the interesting thing here with technical analysis, and different from a lot of other things, the beauty of trading in capital markets is it's literally the same frameworks, the same fundamentals that can take $10 and turn it into $20. The exact same rule that you applied there, you can take $1 million and turn it into $2 million. You can take $100,000 and turn it into $2,000 or $200,000. Hopefully you're not taking $100,000 and turn it into $2,000. That's the opposite of what we're wanting to do here. So basically today I'll be breaking down an analysis framework, 4 key things with technical analysis in general, and then really we're going to be hopping into the charts. But first of all, the most important thing is psychology, and that's what I talked about in that first video right over here on the introduction basically to this course. It's called number 1, Frameworks and Paradigms Technical Analysis Program. Right here, go check that out because it is vital. You do that. Do not watch this video before you go watch that video. You have to watch these in order. Especially you need to understand that video because that's really one of the main components of building a trading strategy. And really it comes down to psychology, risk management, entry points, and exit points. Okay, so if you only have an entry point and you're not thinking multiple steps deep to your exit, you've already failed. You want to begin with the end in mind. So many people are just like, oh, this is a great time to buy. Elon's talking about Bitcoin or someone's talking about this, and they only look at sentimental analysis. No, we're looking at technical analysis. We can combine these other things with fundamental, sentimental, and on-chain analysis together to provide a great entry point. But before you enter, you want to exit. You want to have already in your mind figured out when you're going to exit. And when you start building this plan, you can essentially remain rational. And if your emotions kick in, you can go, okay, wait a second, I have a plan. And the number one thing for this, this may be crazy, this may blow your mind, but it's investing in one of these, a little notebook. This is the first one I ever got. This is actually my original trading notebook. And I recommend just simple things like this. Throughout this course, just simple patterns. I'm not the best. I prefer to speak rather than write, but literally just take notes. I mean, if you think that something that can literally double your money in a couple of hours, and yes, you can do that with technical analysis, just like you can ride a wave. If you think something that has this power is not worth taking notes on, this is not for you. Go watch something else. Go watch Netflix. Go watch Hulu. Go play video games, whatever you want. This is not for you because so many people work their asses off their whole entire life just to trade their time for money. In this case, you're trading your money for time, and that's ideally what you want to do. Love him or not, Robert Kiyosaki in his book Rich Dad Poor Dad laid out that basic framework that is vital. You want to switch from where most people trade their time for money to trading money for time. And how you do that is essentially outsourcing a lot of things. And outsourcing these like day-to-day tasks like I talked about in that first video, that's why you should watch that. And so you can kind of focus on the one thing. Gary Keller has a great book called The One Thing. Basically, what you should ask yourself every single day is what is the one thing that will basically remove all these other things that I need to do? Because if I can do this one thing, I can essentially just pay for all these other things. Like that's essentially the framework. You can outsource most of these other things. For example, cleaning, cooking, driving on a day-to-day basis. You don't have to do this. You can focus on the one thing that you're skilled at. If you get skilled at technical analysis, you can actually outsource these other things. If you don't enjoy doing them, why do them? I mean, I've been able to travel for pretty much since I was 19, 18. It's ridiculous. When you're able to do these things, you really have pure freedom. This is the really only time in history when we've been able to do this. Think about, let's just say 100 years ago, or let's say 200 years ago. The richest leaders in the world are not able to have the same freedom abilities, not able to have the same freedom of movement that we're able to have today. And you don't have to be born into a wealthy family. Doesn't matter how old you are. Doesn't matter your name. Doesn't matter your ethnicity. None of these things matter. So the point here is invest in a freaking notebook. That's my point. That's really the main thing here. So like I said, when you think about building an investment framework, it's really about building a set of rules. And we'll talk about how to kind of frame this set of rules in the charts here. But I just kind of want to explain this as just an introduction. So first, psychology. Once you have your psychology down, you can understand that you want to remove emotions, you want to apply logic, apply rationality. Okay, you got that. Now, the second thing is really building that framework, like I said. So when you're looking at that, you're looking at risk management. So the basics, let me just show you right here on the charts. We're going to use Bitcoin by example for today. Let's go here and we'll remove these lines, remove drawings, remove these indicators. Next, the next thing in this will be basically the next part in the series will be on indicators and kind of moving past fundamentals to part like one of three of indicators and tools. Today we'll be focusing on the basic, and again, it's not basic, it's the fundamental. It's the fundamentals of technical analysis, which are vital. But as I was saying, let's go here, let's zoom out. Okay, so basically with risk management, this is like a crash course in less than a minute on risk management. A freaking stop loss. It's called a stop loss. This automates your risk. Like I explained it in the beginning, the video that I posted today, I did technical analysis on BNB token. And when I did this, I literally said, when you use a stop loss, it's like being able to ride a wave, but once you start getting a little tilty, once you start feeling like you're about to fall off the surfboard, you're back on shore. That's literally what a stop loss is. That's genuinely what it is. Basically, it takes you out of a position at any point that you set. So let's say you only want to risk a tiny amount. You can only potentially lose $1. That's all you're trying to risk. Set your stop loss to 0.03%. That you're going to lose less than $1. You can make multiple trades without losing $1. Okay, and obviously it depends on your leverage and different things like this and how much capital you're using. But that's just an example. Basically, what a stop loss allows you to do is to, as you're riding the wave of a capital market, be able to hop off, be back on shore, safe and sound, as long as you've set it up before you start surfing. That's the main thing. Before you start surfing in the markets, you have to set your stop loss. And there's many ways to do this. You can set a trailing stop loss. But a great point here is, let's just say you were to enter a position here. So let's say you wanted to go here. You're like, man, this thing is going to pump. Obviously, you can't see any of these things, so we can just move this. So let's just pretend like we are right here in the markets, okay? Right about here. So if we're just looking at this area, you're going to go, okay, I want to maybe do an entry position again. This is purely as an example, but I can't afford to risk that much, okay? And let's just say you're doing like, I don't know, 5x leverage. You set your stop loss. All you do is first when you're trading is you have to, first of all, just go on TradingView. Do not trade from the charts on an exchange. Ideally what you're doing when you're trading is you're looking at TradingView on one device and you have an exchange on another device, especially if you're doing quick trading. Now, if you're doing macro trading, things like swing trading where it's like multiple weeks or multiple days, you can do this on the same device. But if you need to get into quick position quick, which by the way, at the end of this series, we're going to be talking about day trading, swing trading, all these different things. But the point is, when you're doing this, you want to first map it out on TradingView. You want to make sure you're using the exact exchange you're using. So Bitstamp is kind of a good one for just the historical price of Bitcoin. But let's say you're trading Bitcoin on Femex. Let's say you're trading it on Binance. You want to make sure up here in TradingView that you have this set up to the proper one. So BTC USD, you can see, okay, Binance. You can see, okay, BitBay. You can see Bybit. You can see a Femex down here. So you have to make sure you're on the exact one because there can be some price discrepancies. But the point is that's kind of the first thing. And you want to make sure you're using TradingView so you can chart it out, make your plan, make your decision, have your psychology right, have your risk management right, and then we'll talk about entry and exit points. So having the risk management is having the proper stop loss and making sure that, just like if you're going to go to a casino, that you want to go, okay, I'm having this set of money. If I lose for today, I'm walking away. I'm not going to mess with this. I'm not going to keep, hurting myself trying to do this trade. I'm going to, come back with a clear head tomorrow and be able to make sure you can always trade another day. You want to make sure you're never setting yourself up in a position where you can't trade tomorrow, where you can't trade in the next week. You always want to make sure that you're pulling profits and you're able to trade whenever you want. So with this, again, this is what you're looking at with the proper stop loss. So basically you can set this up where, let's see, as I was saying here, so you can move your stop loss up. So let's say we wanted our stop loss to be like right about there. And in retrospect, so like I said, only let's say like you're doing 2x leverage. That means that your risk would be about like 18% there if it's 9%, and then your target would be, let's say, somewhere up here. This again purely hypothetical. Then your target would be 60% profit. So what you would have to do there is when you're writing down your plan, again, in your notebook, you want to start out paper trading first. You don't want to start out, in my opinion, trading with capital unless it's a tiny amount. When you're doing this, you want to write down in your notebook, okay, entry point with Bitcoin. So in this case, entry point, 4,809, whatever that is, 48,000. Entry point, boom. Where's my stop loss? I'm setting this before I enter the position. Before you enter the position, you're setting this up. And again, we'll talk about in the next videos after we do this focus on just technical analysis. When you're in the exchange, limit orders, market orders, cross versus isolated, different leverage points, how you want to use different ones in different cases. But the point here is just to build this fundamentals around the actual charts, okay? So with this, you would write down in your notebook, okay, got my notebook out, I got my pen. This is from my old marketing company before I transitioned into doing more e-commerce. This is my company's pen. I still have the LLC, by the way, but let's see. So let's go here. So you'd want to literally write down, okay, where is this going to be? I'm going to write down my entry point, my stop loss, my take profit, or my target price. That is setting up your entry. Your entry is here it's the gray number, okay? So you see this, that would be your entry point. Your stop loss is this red number. Your target is this green number. And just practice. Just get started with this. Just practice. As long as you jump in the water. Just like you can't learn how to surf if you don't make mistakes. And the beauty about technical analysis is anyone can do this at any point of time without risking their own capital. And you can just practice paper trading. So get a notebook, practice. If you're scared about the markets, if you're not willing to risk $10 trading, just start paper trading. It's very, very powerful. Now, you will be much more interested if you have your own skin in the game with capital. That's kind of how I got started. I was just like, man, I have a lot of profits from a lot of different investments. I'm going to get started in learning these things. You learn through mistakes. That's how people learn. And as Warren Buffett says, everybody learns from mistakes, but it's a heck of a lot easier to learn from other people's mistakes. So ideally what you're doing is learning from other people that jumped in the position that you did, except you were paper trading. So you get to learn from other people's mistakes and go, okay, I'm going to change this, iterate and improve, and work on my, again, psychology, risk management. After risk management, you have entry and exit positions. Those are the four main things. So psychology, risk management, entry, exit, okay? Every single trade, you have to have these things right. Just let's take a brief example. We talked about how you can write these things down. So you're writing down your risk management. Okay, my risk management is I'm going to set a stop loss. It's very, very basic. There's many other ways to do this, but for the sake of this video, for the fundamentals, setting a stop loss is your risk management. Your entry position is just if you do a long position on TradingView, which is this little indicator right here. When you click these arrows, you can see long or short. So if you want to short the market, for example, here, if you would have wanted to short it right here, you'd set your stop loss, so your risk management. You'd write this down in your notebook. Okay, so my stop loss here, this number. Gray number is entry position. Green number is target. So entry, exit, risk management. Now, how do you practice psychology? The easiest way to do this, in my opinion, if you don't already meditate, just before you make a trade or before you jump on TradingView, before any electronics in the day, just close your eyes, no electronics, no stimulus, nobody talking to you, no TV, no background noise, no music, no nothing. Deep breath in through your nose. Try and do that 10 times. You can either have your eyes open or eyes closed. Ideally, you're looking like out a nice window or something like this, maybe watching the sunrise 10 times by just going in, out, without having something else pop in your head. So you will have the monkey of the mind in the beginning when you start doing this. Something else will pop in your head and you'll start thinking about it. This is just how our minds work, especially in the modern age with these different things. But as soon as that happens, realize it. Don't get mad at yourself, but realize it. Reset. Now, I know this may sound weird, but trust me, this is huge for investing. Huge. Because so many people get caught up in emotions. You have to understand that money is not everything at the end of the day. You can't take it with you when you go. So practicing this psychology, just basic of resetting your mind, having a balanced approach and trying to look at this objectively. Looking at this from a bird's eye view, as if it's not even your own money. Now, you should obviously, that's the point of having risk management, but when you have the proper plan, you can be at peace. And when you do this, it's you don't even have to call it meditation. You can literally just call it mindfulness. I prefer to call it mindfulness because this is essentially training your brain to be able to just focus. And just focusing on your breath is an easy thing. You can choose to focus on an object. For example, this pen. Let's say you just want to focus your eyeballs on the tip of this pen for 60 seconds. So just stare at it and count. And the second your brain thinks of something else, reset. And if you keep doing this every day, keep doing this, focusing on psychology, even like I said, even if it's just for a minute before you turn on your electronic devices, you can actually get really, really good at training your brain if you do this every single day. So if you set this up as a habit, that's just like a basic thing with psychology. Maybe I can talk about more things with this throughout the series, but again, psychology is vital because you have to have this to trade properly in the markets, to actually take advantage of capital markets, again, kind of ride these waves, is you have to have a balanced mind. So many people have made millions and billions of dollars. Look at the guy who started Victoria's Secret, for example. He sold his company for a couple $1,000,000 and a couple days later jumped off a bridge. So it's pretty clear that just because you have all this money, if you don't have your psychology right, you're completely disillusioned. Because again, this is made for another video, but the point is get your psychology right, practice mindfulness, practice being able to just focus on the breath. Every day, just maybe when you wake up, maybe just one. Just start with one. It's better. 0 to 1 is a great book by Peter Thiel. There's a big difference between going from 0 to 1. 1 to 2 is much more easier. Then you have the snowball effect, and you can keep doing this. But again, the point is practicing psychology, practicing these different things. Maybe even in your journal, just practice writing those things down. So I call this like a trading journal. I like the little moleskin. You can get them. You can literally probably get them for free. If you're in most places, it costs you basically nothing. You can start paper trading, and once you're being more confident in it, once you've completed this full series, you can jump in and kind of hop into the ocean, if you will. But it's very important that you have your risk management, your psychology, your entry, and your exit. Those are the 4 key things you need. 4 key things. Now let's take a look at just basics with technical analysis when we're looking at charting. So let's go here. Let's go to the 1 day. I was just going to draw this out for you. So this is a basic way to approach any charts, okay? Is drawing out key support and resistance levels. Now this may seem weird, but again, these are just different time horizons. So each of these individual candles on this is just basic. I mean, this is very, very basic. But each of these candles on a chart represent essentially the data point at which you're using it. So whatever time frame you're using, each candle represents one of them. So if you're on the 5 minute, each candle represents 5 minutes. If you're on the 1 hour, each candle represents 1 hour. Since we're on the weekly chart, each of these candles represent 1 week, okay? So, for example, here, let's just take a look at this. How would you draw this chart out, all right? So what are the key support and resistance levels? Well, what you're going to look for is confluence, all right? So it's much easier to kind of zoom in on this past market and kind of disregard somewhat what we're doing now, and then we'll address that here in a second. So if Bitcoin falls, you have these areas essentially of support. And basically what support and resistance lines help you do is map out. I kind of like it thinking of like a blueprint of a house. So you have the basement, you have the first floor, you have the second floor, you have the third floor, you have the attic, all these different things. Essentially, price will consolidate or kind of bounce in between these different levels. And once it breaks through one, that previous high, so let's say this was a previous support level, is now new resistance. Once it breaks above that, test it again, now it's new support. And again, I'll show you more in detail here, but let's see. And if you're confused at all, just put it in the comments. Throughout the series, we will be repeating each of these concepts. So if it seems like I'm going kind of faster on any of these things, or if it seems like I'm hammering down on these, it's because what's worth knowing is worth repeating, first of all. And then if it seems like I'm going too fast, we will be doing multiple example trading things throughout the rest of this course where we're using each of these skills that we're picking up throughout these lessons, okay? So in the first one, like I talked about psychology, that's why I reiterated it today. What we're talking about today in this course, or in this kind of module, number 2, we'll be talking about in number 3. And keep compounding these things. Like Albert Einstein says, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Okay, so you want to earn it, not pay it. If you're in consumer debt, you're paying compound interest. If you're investing, you're earning compound interest. So you can see right here, this would kind of be like the basement floor, okay? And this is just quick. These are quick levels. And with this, all of these levels are ranges. And the reason I'm going fast here is I'll kind of show you at the end, but you can kind of pick up what I'm doing. It's these areas of confluence, essentially. And the reason that I can do this kind of quickly is because, like I said, these are ranges. These are not exact levels. So each of these individual lines are never an exact point. So you see each of these blue numbers here, this is where I have these lines. It's really a range in between there. So by the way, in TradingView, each of these, I just recommend playing around with it. It's completely free to sign up for. I'll have it linked down below in the description. There is a pro version, but you don't necessarily need it, especially to get started. Let's see. So let me just explain this with these rectangles, okay? So with this, each of these, since they're a range, you see this, that this green box is not this line. But when you start getting good at technical analysis, when you really start focusing on it, you can start, in your mind, when you're looking at a chart, understand that each of these lines is really this rectangle. So you can just picture this in your head. You don't have to actually draw out the rectangle. I hope you understand what I'm saying here. So instead of taking the time to focus on drawing out the rectangle, you can basically just draw the line, and in your mind understand that, okay, this is a range, this is never an exact point. So that's something to keep in mind. Everything in technical analysis is a range. It's never an exact point. And when you're doing this, Each of these lines, like I said, is a confluence point. So for example, all these times back here, you see each of these, it's basically been touching and testing this line. Same here, okay? So we saw it broke up past this level, this kind of range down here around 3,500, touch back, wicked down here, pushed back up, really pushed back everything, got rejected here. So this is an area of resistance now, okay? So it came back down. Now this level is a support level, okay? So because it touched here, it wicked down, now it popped back up, pushed up, touched the top of these lines. And again, if you're confused on wicks or anything like this, it's very, very simple. I will explain this here in a second. So, but the key thing is just to focus on key support and resistance levels. You can always rewind this and watch back. So it wicked down here, touched the bottom of this. Now this is new supports, okay? So this is your resistance, this is your support. Now this can be new supports if it breaks above this and retests back down. So essentially once key support is broken, once key resistance is broken, it becomes the new support. And it's the inverse with resistance. So once new resistance is broken, now it becomes new support. Once support's broken, it becomes new resistance. You kind of can see how this exchanges both ways, just like long and short. There's two sides to each coin. So, for example, here, this was a area of support right here. We broke past it. It was like a little resistance point here. You see, we got pushed down, broke above, touched it, tested it. Now, since we tested that point, we're pushing above. Now we tested here. It's a new resistance line. Test back here, this is support. You see, we keep hitting this. We keep hitting this. It's like I'm saying in a house. It's that solid floor, but we break down. Now we're on the next level. Okay, but since we've drawn this out, since it's a historical level, we know that, okay, we're testing here, pushing up, breaking past this. Now this level of a previous resistance is new support. Back up here, we're trying to look up here, pushing back down, kind of consolidating in this range, slowly moving up, pop backing up. Okay, so that's basically support and resistance. And the homework for today's lesson is basically go to any other pair, any altcoin. Ideally, actually, you should do this with currency pairs. So go to, for example, like I said in the beginning of the series, you can apply this to crypto, you can apply this to Forex, you can apply this to really anything you're trading, commodities. Go to, let's say, Japanese yen to US dollar, or Turkish lira US dollar, or euro US dollar. Go to those and just draw out key support and resistance levels, okay? So find these areas of confluence. When I mean that, essentially they have multiple touch points. And the more you draw out, the better, okay? The more you can find, the better. And you can go into, let's say, like the daily time frame and focus on this. But the weekly time frame for something like this is interesting. And when you look at this, okay, so now this massive rise, now we have these levels. Okay, if Bitcoin dumps all the way back down, we have these key levels set up. So you can essentially have a trading position set up that you can enter into. And lastly here, I'm just going to focus on, like I said, this is literally just the basics. If you understand support and resistance levels, if you practice this every single day, you can really get good. Like I said, Michael Jordan practiced bounce passes every single day at practice. Okay, so just the anatomy of a candle, of a candle. Okay, let's break this down here. The anatomy of a candle. Let's pull out our little drawing tool here, and then we'll wrap it up. Hope everyone's having a great Sunday, by the way. All right, so this right here is the body of a candle, okay? That's the body of the candle. So it doesn't matter if it's a green candle, it doesn't matter if it's a red candle. Essentially, the difference between a green and a red candle, you don't even necessarily have to keep them green and red. You can change the color if you want. You can customize all these different things. But green is bullish, red is bearish. So if the candle ended in a essentially bullish price action, basically that it went up, it's a green candle. If a pattern or a candle ended in a bearish price action, it would end red, okay? So essentially, this is the open. Okay, let's go here. So for a red candle, the open would be right here. This is the open for a red candle. For a green candle, it's the opposite. So for a green candle, for example, the open would be here, the close would be here. So just for now, focus on the body, and then we'll talk about a wick. So for this green candle, this would be the enter, this would be the close. But for this red candle, remember, this is not the entry. This is the close because it's the inverse. Because this is a bearish candle, this was the entry up here. Oh, come on, little stop. 1 second. Let me get rid of this guy. Okay, sorry about this. Boom. Let's pull it across here. This is why playing around with TradingView is important. Okay, so there we go. All right. So this is the open. This is the close. Right? So when you're doing your key support and resistance level on whatever chart you choose, so again, just take a chart. Ideally, it's like a historically long chart. So maybe you choose Ethereum, maybe you choose XRP, maybe you choose Euro US dollar, maybe you choose gold. Any of these things, you just want to take a look at these things and start understanding them. Now, these are the wicks, okay? So essentially what these candles are is it's reflecting all of the price change in that set time. So remember, like I said, each of these candles represent whatever time frame you're on. So if you're on the weekly time frame, this candle represents the week. But what does this wick mean? What does this little line up here mean? Why do I talk about getting wicked out? Well, there wasn't a close or an open there. Rather, price in this full time frame. So in this week, for example, when this candle closed, or for example, this candle has not closed yet. So a better example would be this green candle. Okay, so right here. And again, throughout the series, I'll keep iterating on this and making sure you understand it. So this is everywhere price went in this individual week, okay? So since this was a bullish week, it's a green candle. We started here, we closed here. But the price after the start got pushed down here, but it didn't close here. If it closed there, it would be a bearish candle, okay? But since the price ended above the entry point, it's a bullish candle. If the price would have been below that wick, it would have been a bearish candle. And again, if this is confusing, just rewatch it. Basically, if this is confusing, just let me know in the comments, and I'll make another video on just specifically the candles. Maybe in next week's, again, the next one will be dropping on Sunday. But again, understanding this is the body of the candle, these are the wicks, and this is the entry. For example, this is the opening position of the week. This is the exit. And it's the exact same thing on the 5-minute candle. This is a beautiful thing about technical analysis. Not only can you apply it to crypto, Forex, whatever you're trading, but all these rules apply to every single chart. So, for example, this is on the 5-minute chart. And I'll wrap this up here in a second. Let me go here. Okay. So on the 5-minute chart, let's look at this. So each of these candles represent 5 minutes, right? So when you zoom in, you're going, oh, wait a second, that's starting to look like the weekly, right? Like it looks about the same. So it's the same thing. This is the body of the candle. This was the entry. This was the starting position right here. This was the ending position. For example, in this bullish pattern, this bullish candle, this was the starting price. This was the ending price. And let's just say for this one, okay, this was the starting price. So this was the closing price, but price got pushed all the way up in this 5-minute time frame, just like in the weekly time frame. This wick represents where price was historically in the time frame, but then the bears came in, sold it back down, boom, closed there. So then closed here. So essentially the wick represents just kind of, think about it like the stamp of where everything went. So like it may be a little bit hard to understand in this video, but once you start looking at the charts more, you'll start picking up on this. But it's basically like the historic pattern of where price went. So it's like having the concrete imprints almost of where price has gone, and the external part. So this is like the wick. So price throughout this whatever time frame. Let's say, like for example, we're on the 5-minute time frame. Price has gone up here, started here, closed here. These extra points here are the wicks. So this is the candle. These are the wicks. Okay. So that's basically how we want to think about it. Again, if you're a little bit confused, I can talk about it in the next global TA, but that's all for this one. I'm happy to answer questions in the comments down below. As always, if you enjoy these videos, definitely save the playlist, share the playlist if you want to have someone else learn technical analysis. I try to make these as evergreen as possible. I'm already open to redoing any of these parts once I finish this series. So I'm always trying to iterate and improve this. Again, most people are charging like thousands of dollars for a course like this, but I want to make sure that I can put it out there for free, so it doesn't matter where you are in the world, doesn't matter how old you are, doesn't matter your ethnicity, doesn't matter your religion. You can learn how to trade in capital markets. That's all for today's video. If you liked it, hit the like button. Pretty obvious, right? If you enjoyed it, definitely subscribe to our channel, hit the notification bell to stay up to date. Again, the next global TA number 3 will be posted next Sunday, the next Sunday from now. As always, invest global, and until next time.